Welcome back. Today we're taking on a topic that tends to split the entire crypto space right down the middle. You've probably seen posts floating around social media claiming that holding 10,000 XRP could reshape a family's future. Some people treat those posts as inspiration, others dismiss them as delusion. And somewhere between those reactions, the real question gets lost. Why are people even thinking about XRP in long-term multi-generational terms to begin with? That's what we're going to explore today. Not the hype, not the emotional headlines, and not the exaggerated claims, but the reasoning behind why these discussions appear in the first place. And before we dive deeper, let me be absolutely clear. The community models you see online, including the ones that reference assumed future valuations like $1,000 or $5,000, are hypothetical illustrations, not predictions, not guarantees, and not financial advice. They're simply frameworks people use to picture what long-term transformation could look like if this technology continues progressing the way some believe it can. The moment you strip away the emotional reaction, the conversation becomes much more interesting. Because when a community begins thinking in multi-dad or multi-generational terms, it usually signals that something deeper is happening beneath the surface, something tied not to price speculation, but to the evolution of financial infrastructure itself. And while these hypothetical models spread across social platforms, something far more concrete has been unfolding quietly in the background. Institutional capital has started positioning in XRP at a scale we haven't seen before. Spot XRP ETFs have now crossed over $1 billion in assets under management. And what's remarkable isn't the number, it's how it happened. No hype campaigns, no retail-driven mania, no emotional rush, just steady, methodical inflows from asset managers who are known for moving slowly, cautiously, and only with a clear purpose. That kind of behavior tells you something important. When institutions are accumulating quietly, they're not doing it because they saw a meme or read a price prediction. They're doing it because they understand liquidity structure, regulatory frameworks, and settlement mechanics. They're focused on whether an asset could play a role in the broader financial system. Not next week, not next month, but over the course of years. And that's where the link between the community's long-term thought experiments and the institutional flows becomes clearer. They may use very different language, but both perspectives revolve around the same underlying idea. What happens if XRP becomes embedded into real settlement infrastructure? The online models paint a narrative version of that idea. Institutions, meanwhile, act on the structural components, supply, custody, regulated instruments, and liquidity compression. When two completely different groups of people, retail communities, and conservative asset managers start focusing on the same asset but from different angles, it's usually worth paying attention. None of this means anyone should expect guaranteed outcomes. None of this means the future is already written. What it does mean is that XRP continues to be part of conversations that extend far beyond price charts. Conversations about financial plumbing, interoperability, efficient settlement, and tokenization at scale. That's why people discuss long-term potential, not because they expect fast wealth, but because the underlying technology intersects with long-term structural change. So instead of treating discussions like the 10,000 XRP model as literal forecasts, it's more useful to view them as a reflection of how people conceptualize long-term value when they see an asset moving step by step into institutional frameworks. It's a mindset exercise, not a roadmap. And the mindset behind it, patience, discipline, long-range thinking, actually aligns far more with how major financial players operate than most retail investors realize. That context matters, especially now because the gap between short-term price frustration and long-term structural development has never been wider. And that's exactly where today's deeper conversation begins. When people talk about the 10,000 XRP model, most outsiders misunderstand what the conversation is actually about. They think it's a promise, a prediction, or some kind of shortcut to wealth. In reality, the people who share these posts online are usually trying to articulate a mindset, a way of thinking about long-term value, disciplined ownership, and how a maturing financial system could reshape the way families interact with assets. Over time, it's not about expecting XRP to hit unrealistic numbers overnight. It's about exploring scenarios that help people think deeper about patience, infrastructure, and intergenerational planning. So let's break it down clearly and responsibly. When the community references numbers like $1,000 or $5,000, these aren't projections or claims of what will happen. They're simply hypothetical placeholders, tools used to visualize what long-term maturation of a utility-driven asset could look like if the ecosystem grew substantially. The numbers are symbolic, not predictive. You could replace them with any values and the philosophical point would be the same. People are trying to explore how long-term systems thinking differs from short-term speculation. This is something that many early communities and emerging technologies do. It happened with early adopters in cloud computing, electric vehicles, mobile networks, and digital payments. They use simplified models to talk about what adoption might mean decades into the future, not because they know the exact path, but because they understand the potential scale of the transformation. The purpose is not accuracy, it's perspective. The hypothetical model that gets circulated often starts with a simple idea. If someone accumulates a fixed amount of an asset early, and that asset gains relevance as its utility expands, what does that mean for future generations? Again, this is not a forecast. It's a narrative framework that helps people think about long-term discipline. The notion of never selling, for example, is less about literal behavior and more about exploring how wealthy families historically treat appreciating or productive assets. They borrow, they build, they reinvest, and they maintain ownership over long stretches of time. Whether someone agrees with that mindset or not, it reflects a shift away from fast profit thinking and towards structural thinking. It's a way of training your mind to evaluate assets not based on weekly volatility, but on long-term utility and network development. And when people apply that framework to XRP, it's because XRP is increasingly positioned in conversations about settlement mechanics, tokenization, and cross-border infrastructure, areas that evolve over decades, not weeks. Another reason these hypothetical models resonate within the community is because they highlight something that the broader market often overlooks: the difference between price action and infrastructure development. Price is emotional, noisy, and heavily influenced by short-term sentiment. Infrastructure is slow, deliberate, and usually invisible until it reaches a tipping point. When people talk about holding XRP for long-term scenarios, what they're really acknowledging is that utility-driven assets don't behave like speculative assets. Their value, if it grows, tends to reflect adoption, not hype cycles. The deeper layer to this conversation is psychological. Most individuals in financial markets are trained through experience or social pressure to focus on immediate outcomes, quick wins, rapid movement, instant gratification. Long-term thinking feels uncomfortable. It requires patience, uncertainty, tolerance, and the ability to separate noise from signal. That's why community discussions that explore multi-dead frameworks stand out. They go against the default behavior of retail investors. It also explains why critics often mock these conversations. It's easier to dismiss long-term thinking as unrealistic than to acknowledge the reality that major structural shifts take time. The irony is that institutions, the same ones now entering XRP through ETFs, naturally think in long horizons. Pension funds, sovereign wealth funds, insurance companies, and asset managers often operate on decade-scale strategies. They don't care about daily candles. They care about whether a network solves problems efficiently and predictably at scale. So when the community uses hypothetical numbers to talk about a future state of the ecosystem, it isn't about guessing the price. It's about aligning with a different psychological framework, one that mirrors how long-term capital behaves. You can disagree with the scenarios, but the mindset behind them reflects maturity, not recklessness. The real value of the 10,000 XRP discussion isn't the model itself. It's the reminder that long-term potential is rarely obvious in the moment. And the people who think in decades rather than days tend to interpret market structure, regulatory progress, and institutional behavior very differently. When you step back from the community mindset and look at the actual market structure developing around XRP, the contrast is striking. The hypothetical models circulating online may spark debate, but the institutional behavior unfolding right now is measurable, quantifiable, and increasingly difficult to ignore. This is where the conversation shifts from imagination to mechanics, from what people talk about to what institutions are actually doing. The biggest example is the rapid growth of spot XRP ETFs. Crossing over $1 billion in assets under management is not a trivial milestone, especially when it happens with zero hype. What matters is the behavior behind the number. Steady daily inflows, consistent accumulation, and virtually no marketing push. That's not retail. That's not emotional trading. That's methodical, structured capital positioning itself quietly. If you look at the flow data, you see something even more telling. These ETF structures are absorbing meaningful amounts of circulating XRP every single day. Based on current market conditions, the inflows translate to millions of tokens, exiting the liquid market daily and entering regulated custody. Again, this doesn't guarantee anything about future price, but mechanically it does reduce open market supply. And historically, when liquid supply tightens, while interest grows, market behavior eventually shifts. The timing is unknown, the magnitude is unknown, but the mechanics themselves are straightforward. Why does this matter? Because it shows a clear divergence between how retail treats XRP and how institutions treat it. Retail focuses on candles, frustration, and narratives. Institutions focus on supply pathways, regulatory clarity, and exposure vehicles. ETF participation is not speculative noise. It's structural positioning. Asset managers like Franklin Templeton and Bitwise are not in the habit of taking uninformed early bets. They move when they see a long-term framework forming, not because they know the future, but because they understand the architecture being built. This is reinforced by data from WisdomRe, which recently highlighted that XRP is one of the very few digital assets attracting sustained institutional inflows across every major region. That means North America, Europe, and Asia all show consistent demand for XRP products, even during periods when most other crypto assets saw net outflows. It's significant not because it predicts anything, but because it reflects sentiment at the professional level, sentiment that is often grounded in infrastructure readiness, regulatory outlook, and perceived utility. Another important point is the role XRP plays within the broader conversation of settlement systems. Unlike many crypto assets that rely primarily on speculation or ecosystem narratives, XRP is consistently discussed in the context of payments, cross-border liquidity, and tokenization frameworks. Whether someone believes in the long-term vision or not, it's objectively true that XRP is part of institutional conversations about financial infrastructure. That's not retail hype. That's positioning at the structural level. This is exactly why the supply mechanics tied to ETFs matter. Each unit held inside an ETF structure is not part of the open, free-floating supply anymore. It sits in sealed custody, functioning more like a locked component of a regulated product than a trading instrument. Over time, if inflows persist, circulating supply becomes increasingly constrained. Again, this doesn't dictate an outcome. It simply changes the market environment. The disconnect between daily price movement and underlying structural developments becomes more apparent when you view the data this way. Emotional market participants often underestimate how slowly large financial systems move. They expect immediate results. Institutions, however, don't operate on the same timeline. They accumulate gradually, test infrastructure quietly, and scale participation only when the ecosystem matures. That pattern is visible in XRP's case right now. You don't have to make exaggerated claims to see the significance. The measurable reality is that institutional participation in XRP products is growing. Supply is steadily transitioning into regulated structures, and global inflows remain consistent even when broader crypto sentiment is mixed. These are early indicators of an asset transitioning from speculation towards structured use. The point is not that this guarantees future success or guarantees major appreciation. The point is that the underlying market structure around XRP looks very different today than it did in previous cycles. That shift doesn't show up in price charts immediately, but it becomes visible in flows, custody patterns, institutional behavior, and regulatory readiness. And when you analyze XRP through that lens, not through hype, not through emotion, but through mechanics, the long-term landscape becomes far more grounded than most people assume. What often gets overlooked in the noise of price speculation is the actual utility conversation happening behind closed doors at institutional levels. And this isn't about hypothetical family models or personal long-term strategies. This is about how XRP is being discussed in professional environments where decisions are driven by infrastructure compliance, liquidity, and operational efficiency. That brings us to the recent conversation featuring Sal G, which offers a surprisingly honest look at how people in traditional finance interpret XRP's role in the evolving financial system. When Sal describes XRP as a bridge asset designed for large-scale settlements, he's pointing to something that has been true for over a decade, but is only now gaining recognition outside the crypto space. Settlement assets are not meant to sit idle, they're meant to move quickly, consistently and inexpensively. As value flows across different networks and jurisdictions, and whether someone supports XRP or not, its design aligns with the requirements of modern settlement frameworks: speed, liquidity, efficiency, and programmability. What's striking in that discussion is that even people who don't have every detail correct still understand the core idea. XRP's relevance comes from function, not speculation. They recognize that Ripple has been building institutional rails for years, integrating with financial entities, and positioning the XRP ledger as a framework that can operate in real-world environments. These conversations don't center around hype. They center around infrastructure, compliance readiness, and the regulatory clarity needed for large banks to participate. One point S makes, and this is worth highlighting, is that global financial movement ultimately roots through the United States at some point. That reality shapes adoption timelines. No matter how advanced a technology is, large U.S. institutions cannot touch it until the regulatory environment gives them a safe operational lane. That's why discussions around clarity are so important. Once U.S. banks receive a clearly defined regulatory path for using assets like XRP, the scale of usage could look very different than it does today. But again, this is not a prediction. It's an explanation of how institutional adoption typically works. It doesn't come from retail enthusiasm. It doesn't come from social media. It comes from compliance teams, risk departments, settlement analysts, and liquidity managers determining whether a tool fits into existing workflows. When Sal suggests that usage could explode with regulatory clarity, he isn't predicting price. He's pointing to the structural bottleneck that has limited participation so far. It's also important to acknowledge a key point raised in that discussion. XRP is a utility token, not a static store of value. Unlike assets designed primarily for speculation or long-term holding, XRP was built to move. It was designed to facilitate transfers, bridge currencies, and enable fluid value exchange between systems that normally don't communicate well. That means adoption isn't measured simply by market cap. It's measured by throughput, integration, and settlement frequency. From an institutional standpoint, that matters. A utility asset doesn't need hype to gain relevance. It needs reliability, consistency, and clear operational pathways. And that's exactly why professional investors pay attention to infrastructure progress rather than community models. They're not trying to imagine decadal-long hypothetical scenarios. They're evaluating whether this technology fits into the direction the financial system is already heading. And that's where the larger picture becomes clear. Whether someone agrees with the long-term enthusiasm surrounding XRP or not, the asset is undeniably positioned within discussions about tokenization, real-time settlement, and cross-border efficiency. You don't have to assume a specific future outcome to recognize that XRP remains one of the few digital assets consistently examined for practical use cases rather than purely speculative ones. This is also where institutional flows and utility conversations intersect. ETFs absorbing supply, regulated exchanges offering access, and institutions exploring settlement use cases all contribute to an environment where XRP's role shifts gradually from speculative instrument to functional infrastructure component. That shift is slow, quiet, and data-driven, which is exactly why many market participants miss it. The significance isn't in predicting what comes next. The significance is in understanding the direction of development. XRP doesn't need dramatic announcements or viral news cycles to gain relevance. It needs continued integration, regulatory clarity, and consistent demonstration of utility. And right now, those pieces are developing more visibly than in previous years. When you connect the dots, institutional conversations, ETF flows, settlement design, and long-term infrastructure building, the relevance of XRP becomes less about imagination and more about mechanics. And that's where the real long-term implications begin to take shape. When you put all of this together, the hypothetical long-term models, the community shares, the structural market developments, the institutional conversations, and the expanding utility, a clearer picture begins to form. Not a picture of guaranteed outcomes or predetermined futures, but one of a technology that continues to evolve in ways that the broader market often overlooks. And this gap between perception and reality is where a lot of misunderstanding around XRP comes from. The 10,000 XRP discussions, when stripped of emotion, are really just reflections of how people think about long-term value and disciplined ownership in a changing financial environment. These models don't exist because people expect specific numbers or fixed timelines. They exist because individuals are trying to understand how a network with real-world utility might function if adoption grows over decades. It's a mental framework, not a financial roadmap. Whether someone agrees with it or not, the point is the mindset behind it. A shift toward patience, responsibility, and generational thinking instead of short-term speculation. At the same time, the institutional world operates on an entirely different set of signals, and recently, those signals have become more difficult to ignore. ETF inflows, sustained custodial demand, structural supply reduction, and ongoing engagement from major asset managers all point to a reality that doesn't match the surface-level skepticism you often see online. Institutions aren't emotional participants. They don't chase hype. They position where they see long-term infrastructure taking shape. The fact that XRP continues to attract methodical global inflows even during periods of market weakness tells you something about how the asset is being evaluated, not as a meme, not as a speculative trade, but as a potential component of emerging settlement architecture. And that's why these developments matter more than any short-term chart pattern or temporary market cycle. Then there's the conversation around adoption, not theoretical adoption, but real movement within institutional frameworks. What we heard from people like Sal G reinforces a simple truth. XRP's relevance is tied to function, not market noise. As regulatory clarity improves, as banks receive defined operating guidelines, and as tokenization grows across traditional financial sectors, the infrastructure ripple has been building for years becomes increasingly visible. This doesn't mean everything happens at once. It doesn't mean there's a guaranteed trajectory. It simply means the groundwork for meaningful usage continues to expand quietly, piece by piece. And when you view XRP through that lens, utility, infrastructure, global flows, and settlement design, the long-term narrative looks very different from the short-term emotions that often dominate social media. This is why it's important to separate noise from structure. Noise is the price chart on a red day. Noise is the criticism that ignores context. Noise is the impatience that pushes people toward short-term thinking. But structure, real structure, is built slowly. It develops through regulation, partnerships, liquidity frameworks, and infrastructure that can support institutional participation at scale. If there's one takeaway from everything discussed today, it's that XRP's story has never been about quick gains. It has always been about the long-term evolution of financial rails. The community's hypothetical scenarios speak to that long-range mindset. The institutional flows reinforce it with data, and the conversations happening inside the traditional financial world indicate that utility-first assets are finally entering mainstream dialogue. As always, none of this guarantees a specific future. Markets change, conditions evolve, timelines shift. But understanding the fundamentals and evaluating developments through a calm analytical lens is the best way to navigate an asset that is deeply tied to the future of settlement infrastructure. If you found value in this breakdown, let me know your thoughts in the comments. What part of today's discussion stood out to you the most? And how do you interpret the gap between retail expectations and institutional behavior? Thank you for watching Journey to XRP. Your support truly helps keep this channel moving forward. Stay informed, stay focused, and continue evaluating the data with clarity. This content is for educational purposes only. It is not financial advice. Always do your own research before making any investment decisions.